Welcome to the ultimate beginner's guide to blockchain and cryptocurrency. We're setting off on a journey of discovery, exploring the fundamentals of this revolutionary technology and digital currency. This guide will serve as your compass, helping you navigate the often complex terrain of blockchain technology and cryptocurrency. Today, we're taking a deep dive into the basics of blockchain and cryptocurrency. We'll start by answering the question, what is blockchain? And then move on to the intriguing world of cryptocurrency. We'll also guide you through setting up wallets, buying cryptocurrencies, and even how to analyze them. Our journey won't stop there. We'll delve into the risks associated with crypto investments and share some best security practices. And of course, we'll wrap up with a summary and next steps to help you continue your crypto journey with confidence. Ready to take the first step into the world of blockchain and cryptocurrency? Let's dive right in. So, you might be wondering, what exactly is blockchain? In the simplest terms, blockchain is a decentralized ledger technology that provides a secure and transparent way to record transactions. Imagine it as a digital chain of blocks where each block contains data and is linked to the next one using cryptography. But how does it all work? Let's break it down. Each block in the chain contains a list of transactions. When a new transaction occurs, it's added to a block. Once that block is filled with transactions, it's linked to the previous block, forming a chain. This chain of blocks forms the blockchain. Now, the magic of blockchain is that it's decentralized, meaning it's not controlled by a single entity or authority. Instead, it's maintained by a network of computers called nodes. These nodes validate and record transactions on the blockchain, thus ensuring its integrity and security. But how do these nodes agree on what transactions are valid and should be added to the blockchain? This is where consensus mechanisms come into play. The two most common ones are proof of work and proof of stake. Proof of work is a mechanism where nodes, also known as miners, solve complex mathematical problems to validate transactions and add them to the blockchain. This process requires a lot of computational power and energy, but in return, miners are rewarded with cryptocurrency. On the other hand, proof of stake is a more energy-efficient mechanism. Instead of competing to solve a problem, nodes are chosen to validate transactions based on the amount of cryptocurrency they hold and are willing to stake or lock up as collateral. Let's take a real-world example. Bitcoin, the first and most well-known cryptocurrency, operates on a blockchain using a proof-of-work consensus mechanism. When you send or receive Bitcoin, that transaction is recorded on the Bitcoin blockchain, verified by miners. And then it's there, immutable and transparent for anyone to see. But remember, the Bitcoin blockchain is just one example. There are many different blockchains out there, each with their own unique features and uses. From Ethereum's smart contracts to Chainlink's Oracle networks, the applications of blockchain technology are vast and growing by the day. So there you have it, a basic understanding of what blockchain is and how it works. With blockchain, we have a secure, transparent way of recording transactions. But how does cryptocurrency fit into this? Let's find out. Now let's talk about cryptocurrency. You've probably heard the term thrown around in conversation, but what exactly is it? Cryptocurrency, at its core, is a digital or virtual form of currency that relies on cryptography for its security. This makes it extremely secure and difficult to counterfeit. But unlike your traditional coins and notes, cryptocurrency isn't controlled by any central authority like a bank or a government. Instead, it operates on a technology called blockchain, which we've just discussed in the previous scene. Now, you might be wondering, what are some examples of these cryptocurrencies? Perhaps the most well-known is Bitcoin, the first ever cryptocurrency, which came into existence in 2009. Since then, thousands of different cryptocurrencies, also known as altcoins or alternative coins, have been created. Ethereum, Ripple, and Litecoin are just a few examples of the many out there. But what makes these cryptocurrencies so popular? Well, it's their versatility and potential uses that are truly revolutionizing the way we handle money. For starters, they can be used to make online purchases. Many businesses, both large and small, are beginning to accept cryptocurrencies as a form of payment. This is particularly useful for international transactions, as cryptocurrencies can be sent across borders quickly and with minimal fees. Cryptocurrencies also serve as an investment opportunity. Much like stocks or commodities, the value of cryptocurrencies can rise and fall, and many investors buy them in the hopes of making a profit. Bitcoin, for instance, was worth less than $1 when it was first created, and at its peak it reached nearly $20,000 per coin. Another significant use of cryptocurrencies is for remittances. Sending money overseas can often be expensive and time-consuming. With cryptocurrencies, however, funds can be sent directly to the recipient, bypassing banks and reducing costs, but that's not all. Cryptocurrencies are also being used to raise funds for projects through initial coin offerings or ICOs, much like a company might raise funds through an initial public offering or IPO. And with the advent of smart contracts on platforms like Ethereum, cryptocurrencies are being used to automate contractual agreements, reducing the need for intermediaries. So let's recap. Cryptocurrency is a secure digital form of currency that operates on a decentralized system known as blockchain. There are thousands of different cryptocurrencies, with Bitcoin being the most famous. They can be used for online purchases, investments, remittances, and even to automate contracts and fund projects. Cryptocurrencies are changing the way we handle money. But how do we store and use them? Let's explore. To use cryptocurrencies, you'll need a wallet. Take a moment and picture a traditional wallet. It's a personal, private place where you store your money, right? Now imagine that, but digital and for cryptocurrencies. That's a crypto wallet. There are a few types of wallets you can use, each with its own pros and cons. Let's break it down. First, we have hardware wallets. These are physical devices like a USB stick that securely store your cryptocurrencies offline. They are resistant to many forms of hacking and are a fantastic choice if you're holding a substantial amount of crypto, but they can be a bit pricey and might seem complex for beginners. Next up, software wallets. These are apps or programs you can install on your computer or smartphone. They're user-friendly and usually free, making them great for those just dipping their toes into the crypto pool. But remember, they're only as secure as the device they're installed on, so be mindful of malware and phishing scams. Lastly, we have paper wallets. Yes, you heard that right. Paper. These are simply printouts of your public and private keys, and they're completely offline, which makes them highly secure. But they're susceptible to physical damage or loss. So if you go this route, be sure to keep it safe. So how do you choose a wallet? It really depends on your needs. If you're planning to hold a large amount of crypto for a long period, a hardware wallet might be best. If you're just starting out, a software wallet could be the way to go. And if you're a security fanatic, a paper wallet might be your best bet. Now let's walk through setting up a software wallet, as it's a good starting point for beginners. We're going to use MetaMask as an example, but the process is similar for most software wallets. First, download and install the MetaMask app or browser extension. Once it's installed, you'll be prompted to create a new wallet. Click on Create a Wallet and set a strong password. Next, you'll be given a secret backup phrase. This is incredibly important. It's your only way to recover your wallet if you forget your password or lose access to your device. Write it down and store it somewhere safe. Once you've done that, you're all set. You now have a crypto wallet. You can start receiving, storing, and sending cryptocurrencies. Remember, your wallet is like a personal bank account. Keep your private keys and backup phrase safe and secret. Only you should have access to them. Now that you have a wallet, let's learn how to buy cryptocurrencies. Buying cryptocurrencies is easier than you might think. Let's look at how you can get started. First things first, you'll need to choose a cryptocurrency exchange. Think of this as your digital marketplace for buying and selling cryptocurrencies. Exchanges can be broadly classified into two types, centralized and decentralized. Centralized exchanges like Coinbase, Binance, or Kraken are managed by a single entity which provides a trading platform for users. On the other hand, decentralized exchanges, or DEX, operate without a central authority and allow peer-to-peer trading. Both types have their pros and cons. Centralized exchanges are generally more user-friendly and offer more liquidity, meaning there are more buyers and sellers. However, they can be more susceptible to hacks. Decentralized exchanges offer greater privacy and control over your funds, but can be a bit more difficult to navigate for beginners. Now let's walk through the process of buying Bitcoin or Ethereum on a centralized exchange, which is a good starting point for most beginners. After signing up and verifying your account, you'll need to deposit funds. This can usually be done via bank transfer, credit card, or even by depositing another cryptocurrency. Once your account is funded, you're ready to make a purchase. Navigate to the Buy section. Select the cryptocurrency you want to buy, let's say Bitcoin, and enter the amount you wish to purchase. You can usually choose to enter this in terms of your own currency, like dollars or euros, or in terms of the cryptocurrency itself. Once you're happy with your order, hit buy and voila, you're now the proud owner of some Bitcoin. But what about security? It's crucial to take steps to protect your investment. One of the easiest ways to do this is through two-factor authentication, or 2FA. This adds an extra layer of security by requiring not just a password, but also a code from your phone or an authentication app to log in. And beware of phishing scams. These are fraudulent attempts to obtain sensitive information such as usernames, passwords, and credit card details by disguising as a trustworthy entity. Always double-check the website address before entering your details and never click on suspicious links. Congratulations on buying your first cryptocurrency, but how do you decide which ones to buy? Let's learn about analysis. Before buying a cryptocurrency, it's important to analyze it. And that's exactly what we're going to talk about in this segment. There are two main types of analysis that investors use: fundamental analysis and technical analysis. Let's break them down. Fundamental analysis involves evaluating a cryptocurrency based on its underlying technology, use case, and the team behind it. It's like looking under the hood of a car before buying it. You want to know what's powering it and whether it's built to last. Start with the white paper. This is a document that outlines the project's purpose, technology, and roadmap. It's like the blueprint of a cryptocurrency. Reading the white paper can help you understand what problem the cryptocurrency is trying to solve and how it plans to do that. Next, look at the team. Who are the people behind the project? What's their track record? A strong team with experience in blockchain and business can increase the chances of the project's success. Finally, check out the roadmap. This is the project's plan for the future. Does it have clear goals and milestones? A well-defined roadmap can indicate that the team has a solid plan for growth. Moving on to technical analysis. This involves studying price charts and using statistical measures to predict future price movements. It's like trying to spot patterns in the weather to forecast if it's going to rain tomorrow. Key concepts in technical analysis include support and resistance levels. Support is a price level where a cryptocurrency tends to stop falling because there's demand at that price. Resistance, on the other hand, is where it tends to stop rising because there's supply at that price. Identifying these levels can help you make trading decisions. Now, how can you do all this analysis? Well, there are tools to help you. One popular tool is CoinMarketCap. It's like the Google of cryptocurrencies. You can find information on thousands of cryptocurrencies, including their price, volume, market cap, and more. It also provides links to each cryptocurrency's website and white paper, making it a good starting point for your fundamental analysis. Of course, these are just the basics. There's a lot more to fundamental and technical analysis, but understanding these concepts can help you make more informed investment decisions. With these analysis tools, you can make informed decisions, but remember, investing in cryptocurrencies comes with risks. You're dealing with volatile markets where prices can swing wildly in a short period. So always do your due diligence and never invest more than you're willing to lose. But with careful analysis and a measured approach, the world of cryptocurrencies can be an exciting place to explore. Investing in cryptocurrencies can be risky, but there are ways to mitigate these risks. Indeed, the world of crypto, like any other investment avenue, comes with its share of risks. However, with the right knowledge and strategies, you can manage these risks effectively. First up, let's talk about risk management. In the world of crypto, diversification is your best friend. While it may be tempting to pour all your resources into one promising coin, it's generally a safer bet to spread your investments across a range of different cryptocurrencies. Just like a well-balanced diet, a well-balanced crypto portfolio can help to keep your investments healthy. Another key aspect of risk management is setting stop-loss orders. These are designed to limit an investor's loss on a position in a security. By setting a stop-loss order, you can decide in advance how much loss you are willing to accept, and your investment will be automatically sold once it hits this level. Next, let's talk about some common scams to be aware of. Ponzi schemes are unfortunately rife in the crypto world. These schemes operate by using funds from new investors to pay returns to earlier investors. If a deal sounds too good to be true, it probably is. Fake initial coin offerings, or ICOs, are another common scam. These involve fraudsters enticing investors with the promise of high returns from a new cryptocurrency, only for the coin to be non-existent or worthless. Always do your due diligence before investing in an ICO. Phishing scams are also prevalent. These involve fraudsters tricking individuals into revealing sensitive information, such as their wallet keys, by posing as a trustworthy entity. Be cautious of any unsolicited communications asking for personal information or directing you to a website or application. Which brings us to our final topic of discussion: best practices for security. Your first line of defense is to always double-check URLs. Ensure you're on the correct website before entering any sensitive information. Bookmarking your most used crypto websites can help with this. Another crucial rule is to never share your private keys. These keys are the only way to access and manage your cryptocurrencies. If someone else gets hold of them, they can easily steal all your coins. Remember, in the crypto world, possession of the private keys is possession of the coins. Finally, consider using a hardware wallet for storing your cryptocurrencies. These devices store your private keys offline, providing an extra layer of security. While they can be a bit pricier than other wallet options, the added security can be well worth the investment. By following these best practices, you can protect your investments and navigate the crypto world safely. Remember, the world of crypto can be a wild ride, but with the right knowledge and strategies, you can set yourself up for success. We've covered a lot today, from what blockchain and cryptocurrencies are to how to buy and analyze them. We've unraveled the mysteries of this decentralized world, walking through the basics of blockchain technology, understanding cryptocurrencies, and even setting up your very own digital wallet. We've ventured into the world of crypto exchanges, guiding you on how to buy your first Bitcoin or Ethereum. And we've given you a taste of how to analyze your potential crypto investments, highlighting the importance of both fundamental and technical analysis. Lastly, we've shed light on the risks associated with crypto investments and shared some best practices to ensure your digital wealth safety. Remember, knowledge is your greatest weapon in this digital frontier. So continue learning, stay curious, and keep asking questions. If you found this video helpful, don't forget to smash that like button, subscribe, and leave your questions in the comments. Stay safe and happy investing. That's all for today's guide on blockchain and cryptocurrency. We've covered the basics, from what blockchain and cryptocurrency are, to setting up your wallet, buying your first crypto, and even some basic analysis. We hope this knowledge will serve you well on your journey. Remember, this world is vast and ever-evolving, so never stop learning. We appreciate you tuning in, and we look forward to bringing you more engaging content. Until next time, keep exploring the world of crypto.